As you get ready for retirement, you might hear a lot about annuities and wonder exactly how they work and if they're a fit for you. Plus, during your working years, you've probably focused on building up your assets, and you might not have thought much about what it's going to look like as you draw down those assets, and again, whether or not an annuity makes sense. So let's talk about that. In this video, we'll go over some basic features of annuities. We're going to talk about the different types of annuities that you might encounter, and we will be sure to talk about specifically how this all works with retirement in mind. And then we're going to discuss some of the pros and cons of using annuities, because there's always a trade-off in life. I'm Justin Pritchard, a certified financial planner, and I'm based in Colorado, but I work with people all over the U.S., and if you'd like to talk about working together, that's where you can get in touch with me. So let's start with some basics here, and that's that an annuity is an insurance contract, and people typically use them in two different ways. One is taking income, so that's drawing down assets out of an annuity or getting a monthly payment out of an annuity. The other way that people often use them is for accumulation, and we're going to talk about both of these in more detail. There are also many different types of annuities, and that can get pretty complicated. So I'm going to give you an overview of some of the most popular ones, and that way if you do run across something, you know what you're dealing with. So let's start with that very first one, the immediate annuity. That's kind of the purest and easiest to understand type of annuity, and that might be the type of thing that a lot of people are looking for once they reach retirement. So an immediate annuity will provide income to you. Now, you may have several different sources of income as you get to retirement. You've got perhaps some Social Security and or pensions, and those typically come as a monthly payment. But if those don't cover all of your monthly needs, you would need to supplement that income with your own savings. And there are a couple of ways to do that. You can just, if you have accounts, you can call wherever the account is or log in online and have them transfer money over to you. Or you can use an annuity and set up a systematic stream of payments. So that's the way we're going to talk about it today, but that doesn't mean that an annuity is the only way to spend your savings. You can also just have your money in an account, whether it's an IRA, like an individual retirement account, or some taxable accounts, and you just draw on those savings as needed. The main reason that people use an annuity for income is because you can get guaranteed lifetime income. And what that means is that you would continue to receive payments out of an annuity for the rest of your life, no matter how long you live. So if you live to be 110, those payments keep on going, perhaps longer than they might otherwise. And if you die shortly after starting an annuity, then things get more complicated, and we're going to talk about that. But one of the key features of an annuity is that lifetime income guarantee. So immediate annuities just do that. They don't have a whole lot of other bells and whistles. They give you that income guaranteed, and you have a couple of different choices, because for some people it is intimidating to say, what if I give all of my money to the insurance company and then I die shortly after doing that? Well, then that means I lose most of the money. I don't get the principal back. My beneficiaries don't get it, and that's a problem for a lot of people. So a couple of choices you have when you set up an annuity income stream are the payout options. The biggest monthly payment comes if you just do a single life payout. So that's if you say, okay, here's some money, just pay me out the most that you're willing to pay me for the rest of my life, however long that happens to be, long or short, and when I die, those payments end. Again, a lot of people are not cool with that idea, and they might want to protect a spouse or other loved ones, so you can do a joint life and say, name your spouse. That way, it will continue to pay out for the longer of your two lives. So if one of you dies, the other person does not lose their income. And you may even have some choices on whether or not that income decreases or just stays the same, but the point being that you can have the income payments last for two lives. There's also something called a period certain. This means that an annuity would pay out for the longer of a lifetime or a set number of years. So you could say, let's do a 10-year period certain. And under that scenario, The annuity would always pay out for at least 10 years, so if you die the year after starting the annuity, the income payments would continue. But if you happen to live a really long life, maybe you live another 30, 35 years, the income payments would also continue. So what you've said with a period certain is, a couple of options. You can do a lifetime with a period certain, and that's what I just described. It would be the longer of your life or the time period you choose, or you can just do for a set number of years, and then you assume that you don't need the payments anymore, I suppose. But you have a couple of options to make sure that you're getting income and that the income can continue even after you die. As you might imagine, the payments get smaller as you move away from that single life because you're taking the biggest risk with a single life payout, and that is, again, that you might die shortly after starting the annuity. But if you do a joint life, the insurance company takes a little bit more risk because there are two people to cover. Presumably one is going to last longer than the other, and it also reduces your risk. You don't have to worry about your spouse losing your income or having to decide which one of you is going to possibly die first and is the other person going to be left in a bad place. It reduces your risk and increases the insurance company's risk, and as a result they reduce the amount they pay you. It might not be that much. It's worth looking at, and it might be a price that you're more than willing to pay to make sure that your spouse is protected. Then with a period certain, those can also affect how much you're going to get each month. It kind of just depends on what you have going on and how long of a period certain and how old you are and that sort of thing. So if you're relatively young, picking a 10-year period certain might not reduce things too much. And you might wonder logistically, how does this work with an immediate annuity? Well, you make that payment to the insurance company, and then they would set up some sort of payment to you, and typically the easiest is going to be just to move that money over into your bank account electronically each month. Next, let's talk about annuities as accumulation accounts, and these can act similar to other accounts you might have where you put money in and take money out, although there are some additional strings attached often. And we're going to talk about some of the features that most annuities have in this category, and I'm going to call them, I guess, deferred annuities, and that means you defer or you delay taking the income from these, as opposed to that immediate annuity we just talked about where you make the payment to the insurance company and your income starts. With these, you can defer indefinitely. You might not ever start taking that systematic stream of payments, or you might start several years down the road. It's kind of just up to you which way you go. So pretty much all annuities that don't start paying out income can eventually be converted to lifetime income. So you can make it look like that guaranteed lifetime income with a single life or maybe a joint life payment. That's typically an option for you at some point down the road. Next is that annuities have tax deferral for the most part. So any earnings that you have inside of your annuity contract would typically not be reported to the IRS each year. There might be one or two exceptions. That money is not reported to the IRS, so you don't owe taxes on it each year. You would typically just owe taxes later, perhaps after taking withdrawals. For retirement in particular, this tax deferral feature might not be quite as valuable as you might think, and that's because most of your retirement accounts are probably already tax deferred. So if you have an IRA or a 401k, any assets in those accounts already have tax deferral, so putting them into an annuity for tax deferral would not make much sense. That's the belt and suspenders approach. You would need other reasons for doing something like that. Next is the insurance company guarantee. You want to be careful that as you look at all of the promises made in an annuity, they are only as good as the insurance company that makes them. So you do want to choose really strong, highly rated insurance companies that can continue to fulfill their promises over many decades because your money might be with them for a long time. Next, we have potential tax pitfalls, and this can get extremely complicated, but you ought to know that, and we'll talk about this more later, but you ought to know that as you take money out of an annuity, you may, and you probably will, owe some income taxes on your withdrawals. That can also lead to some tax penalties in certain cases, so be very careful. Speak with your tax advisor before you do that. And finally, we have surrender charges. When you put money into an annuity, the insurance company might say, well, if you take money back out of this and you take too much out, like you might be able to take a limited amount out, such as 10% per year, but if you take too much out, the insurance company may ding you, and they're going to charge you basically what amounts to a penalty fee. And those periods, the surrender period it's called, the number of years during which you would get penalized, those can last 10 years, possibly more. And so it really limits your flexibility if you're using an annuity, so you want to go into that with your eyes wide open. So some quick pros and cons on annuities. We'll start with some of the potential advantages, and that is, again, you can get income for life. That's really one of the key features, is this guarantee from an insurance company that says we'll keep on paying you no matter how long you live. Next is that it could feel like your paycheck or your pension. So once your working years end, maybe you don't feel like managing a withdrawal strategy from your savings and investments. You can just hand that off to the insurance company and they give you a monthly paycheck. You can also basically hand off the investment management, and there are always trade-offs to pretty much any choice you make. But you can say, look, here's my nest egg or some portion of it. I don't know that you want to put 100% of your savings into an annuity. You probably don't. But you say, for this portion, you all handle the investments. I don't want to mess with it. And that way you're not as worried about what the markets are doing or having to just deal with the logistics. And finally, there is some predictability when you use an annuity. So you know how much income you're going to get each month. Again, it doesn't matter what the markets do. With certain products, you can make some long-term projections as well. Again, there are always trade-offs and maybe little gotchas in there, but there is some predictability. What about some of the potential disadvantages? Well, these annuities are designed for the guarantees that they offer. Again, I think lifetime income is probably one of the best guarantees, if not the best, but they can often get misused and misunderstood, both by insurance agents and by the clients who use them. This is something that we could spend a lot of time talking about, but basically I'll just say be very careful before you use an annuity. A couple of things you want to understand is that there are some high commissions for selling these products, and there's nothing against anybody earning a living for the work they do and providing good advice, but high commissions for some people can tempt them to perhaps overuse these, maybe have some blinders on when there may be good alternatives for a client. So it can just be problematic when you're up against that, and you really don't know what people are getting paid in most cases. So I would suggest maybe talking with a fee-only financial advisor who does not get any commissions before you actually pull the trigger on an annuity. You're going to hear sometimes that these products have no fees or you don't pay anything, and you really have to wonder about that. You know that there's no such thing as a free lunch, and those insurance companies have big buildings and the executives are well paid. You don't need to worry about them. So you have to wonder where it's coming from, and it's coming from you. Then in some products, there are particularly high fees. This is primarily about variable annuities, so they at least show you the fees with some transparency for the most part, so that's helpful. But the fees can get quite high, so you need to make sure that it's worth it to pay those fees. As you add what's called riders or additional features, you can bump up the fees. So you really have to make sure it makes sense before doing that. And we talked about the surrender charges before. A lot can change in a couple of years, and especially if you're talking about 5, 7, 10 years, a lot can change. So you want to be careful about locking your money up. Again, you can often get out maybe 10% or some limited amount, but this does limit your freedom when you use an annuity. Now, as we get into these different types of annuities, the easiest to understand is probably a fixed annuity. That just pays you a set rate of interest that the insurance company quotes at the beginning of your contract, and that may last for a certain number of years. Might last for just a couple years, 1 or 2, might last for 3, 4. Some products are even doing longer term guarantees, but the point is you get a set amount each year. Now these can start with a teaser rate, so that's kind of confusing, kind of annoying if it just shows you a really high rate for year 1 and then the rate drops in subsequent years. It's like, okay, you're going to make me do math and figure out what the blended actual earnings are, and you would hope they would just tell you a rate and make it competitive, but these can be confusing, so watch out for that. And with a fixed annuity, if you have not annuitized it or turned it into that lifetime stream of income, you can typically take withdrawals whenever you want. So you might say, I need some money to pay some home expenses. You would just contact the insurance company and request a withdrawal. But you do want to be aware of any surrender charges or what tax liability that's going to cause or any other number of complications that can come up. Then you have longevity annuities, which specifically try to help you insure against outliving your money. So with those, you would make a lump sum deposit, then you would wait until later in life, might be 70s, 80s, for example, and then you would start taking a income stream out of that. So you leave the money with the insurance company for a set number of years, and then you turn on a stream of income later. Next, we have variable annuities. You might have heard a lot about these in recent decades. They would allow you to invest for potential growth. So you are picking securities inside of an annuity contract that can go up or down in value. So it is possible to lose money in a variable annuity. You might pick investments that are similar to mutual funds, so similar types of objectives. And over the long term, you would hope for long-term growth. Again, these can be a bit more expensive because they have mortality and expense charges. You've got the underlying investment charges, and then if you add riders or additional optional features, those would also add to your cost. Variable annuities can also have riders or additional optional features that you can add to your contract. And some of the most interesting ones for retirement might be that you can get income for life, so it lasts as long as you do, but you don't need to annuitize, and that means you don't need to make that irrevocable decision to just start taking the income, and if you die shortly after, you lose. Right? So a variable annuity with a rider can help you address that problem. There are, of course, pros and cons and things you need to be aware of, but this is an option if you say, I want some income for life, but I'm just really not able to accept the idea of losing out if I die shortly after starting an annuity. These products might also have some, let's put it in air quotes, guaranteed growth promises. This doesn't necessarily mean that you're growing an account balance that you can walk away with, but you might be growing what we can call a hypothetical account that you would later take income off of. So if you wanted to walk away or cash out or change your mind or something, this probably would not benefit you as much, but there are some interesting features in variable annuities, so you want to know about those. Next, we have indexed annuities, and these are extremely complicated products, and what they do is measure the movement of an index over specific periods of time. So it might look at the S&P 500 point to point over 12 months and see what it did. These can be really, really complicated. So as you're evaluating them, even the person selling it to you might think they understand it, but it's something you really want to slow down and take your time with, because there are a lot of pros and cons with these products. Index annuities can have some long surrender periods. So again, that would limit your flexibility if you decided that you wanted to do something else or an emergency came up, for example. It could be hard or expensive to get your money back, or just not worth it to get your money back. So you can end up feeling stuck in these. They also have some caps and participation rates. So you might hear that these are linked to investments like the S&P 500, let's say, but you don't typically participate in all of the upside of that investment. A cap might say that you can only get a maximum of 4 or 5% per year gain out of your index. And that might sound like plenty to you, especially if you don't want to take a lot of risk. But the thing to understand is that long-term returns often come in clumps. And so missing out on those big years can often really set you back in terms of investment earnings. And there are also participation rates, which might say, well, you only get, 80% of the upside up to that cap. And so that further limits exactly how much you're going to get out of these. As a result, you probably don't want to use an index annuity with a goal of big long-term growth. It's probably just not going to work out that way. Maybe it will, maybe it won't. Index annuities can also have some of the riders and income features that look very similar to what we were talking about on the variable annuity. So you can get income for life without needing to annuitize the contract or make that irrevocable decision with the insurance company. And let's talk briefly about taxation. So in many of your retirement accounts, you're just going to pay income taxes on your withdrawals because the money has never been taxed. So with a pre-tax account like your 401k, 403b, if you were making pre-tax contributions in those accounts, you owe income tax when you take withdrawals later, and that's at whatever rate you happen to be paying taxes at that point in life. So once you're retired, we can't predict the future and know exactly what rates will be because legislation can change those and your income levels will change. We can obviously make some projections and assumptions, but that's going to be the income tax you pay on any retirement account withdrawal, whether you use an annuity or not, assuming you have pre-tax money. Now, even if you fund an annuity with after-tax money, you would most likely owe tax at some point on some withdrawals, as long as you have some form of earnings in there. So the IRS typically treats annuity earnings as LIFO, or last in, first out, if you just take withdrawals. Again, treat it like an account and call the insurance company and say, hey, I need a few $1,000s. That is often going to be the earnings that you draw out first, and that's subject to taxation. If you do annuitize, it may be possible to treat that as what's called as an exclusion ratio, and that's where a portion of your payment that you receive might be tax-free return of your original investment, and another portion of it would be taxable income to you. This is all stuff you need to talk about with a CPA. So before you make any decisions, I can assure you that this video itself did not provide you with sufficient information to make a decision on your taxes with an annuity. You definitely need to review everything with a CPA. So I hope that helps. Again, I'm Justin Pritchard. I'm a certified financial planner, and if you need help planning your retirement, I would love to work with you. Please reach out. You can use any of the methods there, and we can, just answer your questions. There's no cost or obligation just to chat. This is just an opportunity for you to get a feel for what it might be like working together. And you can learn a lot more at my website as well, see some pricing and see some other things. So I hope you enjoyed it, and thank you.